Hey guys, welcome to another video here at Financial Hub. I'm Caleb Sam, one of the directors here at Financial Hub, and today I want to break down the markets. We want to continue talking about the strategy optimization. This year I've really changed my approach to the markets and the markets that I also trade, and I want to bring you guys up to speed with what I'm doing as well. If you don't know, I stopped trading Forex pairs, so I don't trade currencies anymore. I focus on trading gold, which is a commodity, and trading indices, which is a stock, part of the stock market. Okay, the US stock market. So the only four pairs or the four markets I trade is gold, US 30, which is Dow Jones, US 100, which is Nasdaq 100, and US 500, which is better known as the S&P 500. Okay, now let me share my screen and show you what I've been looking at. So you can see the pairs I'm looking at is gold, US 30, US 100, US 500, okay? And the US 2000 that is there is better known as the Russell 2000. I just look at it, I don't trade it. It's what we call the 2000 small market cap companies in the America, and that's what I focus on. So you can see I'm heavily invested in the US dollar, US stock market. That is basically what I'm looking at. I don't trade indices from England or Europe. I don't trade indices from Australia. I don't trade any from the East countries, only focusing on the American market. So now I've been able to incorporate a couple of things that I've done away with for a long time. My research has led me down to that, and that's what I want us to talk about today. Optimize your trading performance using research and data. I've been doing a lot of backtest, and this backtest is giving me a lot of, and I might do this on a different video, a lot of new approaches and new ideas of how I should be trading. So if you've been following how I've been trading, trust me, I've incorporated something whole new better that I'll start incorporating this year. This is important. Anytime you're trading, you need to take a time where you take a break. Markets are always evolve with it. If what has not been working for some time, come and ask yourself, what has changed? What is happening in the market? So I've been able to incorporate back a few things. You can see on my chart, I have the moving average. So I've brought the moving average back. That is the simple moving average, 200-day moving average. I have others as well. I'm using the 50 MA and also using a different moving average. The moving average are different. There's exponential, there's simple, there's smooth moving average. So I'm incorporating all that, okay? And that's what now I'm trading. Now, what I want to talk about today is I want to break down, you need to understand the difference between the indices you're trading, and that's what I want to focus today. Do some research. In the next video, I'm going to show you now the tools that I use to trade. But for today, I want us to look at the difference, the major differences between these three. Remember, when you cut down and start focusing on certain pairs and certain markets, you start understanding these markets more. When you're trading everything, when you're trading 10 pairs, you don't tend to understand what you're doing. You might think you're building more opportunities and having more opportunities to trade at the end of the day, but trust you me, you're making your trading far worse, far more complex, and you don't get that deep, intensive understanding of the market you're trading. So how the major three indices put together and how they relate. Investors use different collections of stocks to represent the performance of the overall stock market, but each index is put together slightly different, leading to divergence in short-term performance. So when you're looking at markets, if you're looking at this, you can see the Dow Jones has sort of had a significant drop from the all-time highs. It has had a correction of 9.75%. Okay, you can see that 9.75% drop to the downside. If I go to Nasdaq US 100, okay, within the same time period, it has gone down a maximum of about 15%. Okay, you can see that it's a 15% drop. Okay, almost double that of the 9% of US 30. Okay, and when I come to US 500, you get to see that the drop on this one has come down to about 10%. So Nasdaq has the biggest drop, followed by US 500, followed by US 30. Most of you might be wondering, why is that so? Why does this one have more volatility compared to this one? Why is that so? Okay, now that's what I want us to look at, and that's what a little bit of history I want to give you guys. If you're asking yourself, what tool am I using to measure this? Okay, that's just a shortcut where you press shift, then you click on your right click, or is it left? You left click and then you move your mouse. But you can also come here. It's basically the measure tool, okay? This measure tool. So I can just come click on it, click up here just to find the top, okay, that top, and measure how much far down has it gone, okay? So that's basically the measure tool. But back to here, okay? Here the major three you're likely to hear about, the ones that I trade, and the quirks that you can explain the difference. And that's what I want us to talk about today. The S&P 500. When investing pros talk about market returns, they're usually talking about the S&P 500. When you hear people saying the benchmark, how can I beat the stock market? We're always referring to how can we beat the S&P 500, okay? The index tracks 500 largest US traded stocks, comprising 80% of all stocks traded on the market, okay? It was created in 1957. It is important to understand where we're coming from so that you can understand why these markets move in a certain way. The index was the US first index weighted by market capitalization. Market capitalization is basically the stock price times the total outstanding shares. So what that means, let's say for example, I'm trading the Tesla. For example, I'm trading Tesla market. So let's come up here. Let's say I'm trading the Tesla market. And Tesla has a total of 1 million shares, okay? And each share is worth $100, for example, okay? Each share is worth $100. So to get to know the total market cap, what we call market capitalization, okay, you do 100 times a million. So the company is worth $100 million. $100 million. I've just done 100 times 1 million shares. That is the share of the company, the market cap. So if I own 50% of Tesla, it means I own 50 million worth of that company, okay? So I can basically say my net worth is around $50 million if it is directly connected to the Tesla shares, okay? So that is what we call market cap. And today it is the favored benchmark index for mutual fund managers who measure themselves against the broad stock market. Some $15 trillion in investor mutual funds and ETF assets are benchmarked to the index. Everyone who's trading the financial markets always benchmark their performance to how much the index has grown that year. So if you find that the S&P 500 has moved up, for example, 10% this year, and you have done 5% return, that basically means you've underperformed because the benchmark market, which is S&P 500, has beaten you. But if you've done 20% return, and on that time the index has done a 10% return, you've doubled, you've outperformed the index, okay? According to S&P. As of 2021, 7 trillion belong to mutual funds. Those are just extra information. Admission in the index is generally based on the company's size and other mathematical variables for you to be able to be part of the S&P 500, and other criteria may come into play. Okay, Tesla, for instance, was temporarily denied entry despite meeting most fundamental criteria over questions about sustainability of the company's earnings. They tend to fluctuate a lot. Generally though, thanks to weighing the criteria, the S&P tilts towards the largest companies. That means the S&P currently leans towards tech, which makes up about shy of 30% of the index. Okay, so you've seen S&P 500 largest companies in the US. There's a criteria for them to get in, and they are weighted. This index is weighted using the market cap. You're going to see it's different with the US 30. Dow Jones. The Dow is very much your grandfather's stock index. It debuted in 1896 and still carries some of the conventions of an index that existed before computers made stocks easy to track. It holds 30 stocks chosen by a committee, just like the S&P 500, which consists of three representatives from S&P, Dow Jones Indices, and 2 representatives from the Wall Street Journal. Companies are added only if they are deemed to have excellent reputation. To become top 30 is, for example, if you are a fan of Formula One. There are only 10 teams and there are only 20 drivers. Okay, it doesn't mean around the world there are no other drivers. There are many other drivers, but for you to become top 20, to be chosen to become an F1 driver, because each team has 2 drivers, you need to be the best of the best. So the same deeper criteria is used also for the S&P, the Dow Jones, the US 30. Okay, you have to have an excellent reputation, a history of sustained growth and interest among a large number of investors. Okay, another quirk for pre-computer investing is that rather than weighing the stocks in the index by market cap, the top spots in the index go to the stocks with the highest share price. That means certain high-priced names can't be included, as they've become too big an impact on the index performance. So this is what differentiates this drop. You see the S&P 500 having, as you just saw, about 11% drop, and US 30 only has a 9.75% drop, 9.5 thereabout. Okay, it's because the US 30 has very high performing stocks, not just weighted by market cap, but weighted on different things, and that's why it doesn't have much fluctuation to the upside and also to the downside. Okay, not only to the downside, not just because it's going down it has less fluctuation, also to the upside. Okay, it is much safer, it is a much safer stock, it's a much less erratic stock compared to the others. Because of its high quality, high dividend paying firms, what most might call the blue chip, the Dow has tended to hold up better than the other indexes in down markets. So when markets enter into a down period, it is better to have the Dow Jones compared to the others in terms of the fluctuation of the magnitude that the market goes down. In 2022, for instance, the Dow only lost 7% compared to nearly 19% lost on S&P and 32% lost on Nasdaq. Okay, so you need to understand that. And last but not least, the Nasdaq composite. The Nasdaq composite includes of the Nasdaq Stock Exchange, the first electronic exchange. More than 2,500 stocks in the index skew heavily towards the technology and communication sector, which make up 48 and 14% of the index represent respectively. Now, it is important for you to understand there's the Nasdaq Composite and there's the Nasdaq 100. What we trade is the Nasdaq 100, taking the top 100 tech and communications companies. Now, it is important for you to also know that the Nasdaq does not only consist of tech and communication companies. Most of you actually didn't know this communication company. There's media companies and entertainment companies. It also has retail companies. It has much more. It has some financial companies here and there. Okay, but the Nasdaq 100 focuses mainly on tech companies and media companies. Okay, the Nasdaq is weighted by market cap, just like S&P 500, which means fast-growing tech giants tend to dominate. Apple, Microsoft alone account for a quarter of the index. It's easy to see then why the index has posted eye-popping returns of late, as tech and communications stocks have been market-leading run. Okay, each of the top 5, Apple, Microsoft, Alphabet, Amazon, and Nvidia, have posted returns more than 33% so far in 2023, with Nvidia logging in 200% gain. Okay, so that's basically in a nutshell the stock market you're looking at, the indexes. It is important to understand what they comprise of, what they're made up of, so that when you're trading them, when you see Nasdaq or dropping 20% and S&P, Dow Jones only down 10%, you get to understand the difference. So Nasdaq offers also very much opportunities, also offers a lot of losses if you're not taking care. So you need to know how to balance this. Now in the next video that I'll be talking about when we're continuing the strategy optimization, I want to show you the key indicators that I use to trade these markets well, what I've been doing research on, and what will make you understand and trade these markets profitably, as I've been doing in the last couple of months. So I hope you've enjoyed and understood a bit of that information. Do your own research. This is just to kickstart you. Okay, do your own research and find out more about these markets and how to trade them. But I hope you've enjoyed that one, and like I always say, stay woke, stay financially literate. I'll see you in the next video.